and welcome to the Duncan Toplis On Air podcast. I'm Caroline Cleary, Chief Marketing Officer at Duncan Toplis, and today I'm joined by Graeme Hills, our Head of Tax, and Heather Hodson, Chartered Financial Planner, and we are going to explore the initial reaction to the announcements we've just heard from the Chancellor, Rachel Reeves, around the autumn budget for 2025. Welcome both.
Thanks, Caroline.
So let's start with you, Graeme. What's the overall response to the autumn budget?
Well, I think positive, but more because it was so negatively built up beforehand, really. I think last year was a very big budget. I think we're expecting more of the same this time around. So I think with it being lots of doom and gloom on the months leading up to it and lots of big sweeping changes expected, none of those really huge changes came through, and certainly nothing that's sort of swept across the board and taxed everyone. So yeah, I think overall it's a very positive approach overall, and obviously helped strangely by the leak slightly beforehand with all the news coming out beforehand. I think there's a bit of a reaction in the markets, Heather, to that at the time, but it seems to be bounced back already.
Yeah, following the budget, the markets, the FTSE 100 especially has bounced back, so they've responded pretty well.
So I suppose in overall impact, if you were to say, last year's budget was a 7, where's this one in terms of impact for everybody?
For everyone, fairly limited, I think. I mean, the only thing that sort of hit absolutely everyone was the freeze to the personal tax allowances, which is already happening until 2028 anyway. So an extension to that is sort of more of the same. So nothing that sort of makes people shocked. And I think last year we had some much bigger changes with things like the employer's NIC, which has a huge impact across business, and then obviously to working people as well, because there's less money to pay out. And the inheritance tax changes that were announced last year were huge, big sweeping changes which changed how people plan the whole estate. So there were huge changes that they had last year, which I don't think any of that. There's some targeted areas. Some people obviously be worse off. There'll be winners and losers. There always are with these things. But I think last year had a lot more of that big sweeping change that we haven't had quite the same of this time around.
And I suppose when it comes to most significant takeaways, and it could be different whether you're an individual or whether you're a business owner, what would you say is the standout from the statement?
You're absolutely right. That entirely depends who you are. So I think if you are, one of the biggest ones I saw was the 2% increase for those who have got rental income, savings and dividends income. They're quite big changes if that's what your income stream's coming from. Obviously, this is all to do with Labour's pledge not to increase income tax on workers. So they couldn't have a 2% increase in tax across the board because that would be a break of their election pledge. So this is still an income tax increase by 2%, but only in certain areas. So if you're in that sector, if you have a lot of rental income, you are going to be affected by this. If you're renting, you're probably going to be affected by this because your landlord now has more bills to pay. So you can probably expect rent to go up as a result. So, and similarly, if you've got large investment portfolios, I'm guessing all of a sudden your tax is going to go up, isn't it?
It will. So obviously dividend tax going up will mean that there's going to be more tax receipts on investments. So I think what I would say is probably just making sure that people review their investments and trying to maximise the tax brackets for both, especially if you're married, for both spouses. So try and make sure that you're maximising as much as you can get at a lower tax rate.
I think if we can build out on that as well, Heather, with the income tax thresholds being frozen for another 3 years, what are your expectations around that?
Yeah, so I mean, in terms of initial tax receipt, your tax isn't going up from day one, but what the effect will be over time, as soon as you have a pay increase, or if you're a pensioner, state pensions go up, or your pension income goes up, then you're potentially going to be paying more tax over a period of time. So they're extending those freezes until April 2031. So over that period, ultimately, people are going to be paying more and more income tax as a result.
And then with the tax-free salary sacrifices for pensions, that's been capped at £2,000 a year. And what are your recommendations on that one?
Yeah, so at the moment, nothing, because it doesn't come into force until 2029. So we have got time in terms of making any change, reading what the actual rules will look like. So definitely for anyone who's employed and is currently in a salary sacrifice scheme, keep maximising what you can do and how much you can put into pensions, because you're going to benefit from those income tax reliefs and the national insurance reliefs as well. And it is only from a tax relief perspective, even after that date, you're still going to be getting your income tax relief at the current levels, so at your highest marginal rate. It's just going to be the national insurance contribution, which, to be honest, for employees is probably limited. It's more of an effect on the employer, I believe, at that point.
It was a strange change, though, I thought. Because generally speaking, we want to encourage people to save for the pensions and save for the future, so that the government isn't footing the bill in the future with benefits and state pensions. So
Correct.
it was a strange change to put in an extra tax on pension contributions.
It does seem a bit short-sighted to try and encourage people to save in the UK and in terms of getting into investment markets. Your pension's a great way of actually investing into those types of investments. But yeah, to put caps at that level, which is very low, is quite strange. So that has been the only change on pensions that's been announced in this budget, which is great, because leading up to this budget, we've had lots of noise about tax-free cash being withdrawn. So in the least, from a positive perspective and from our perspective, a lot of clients that are in retirement currently will not be affected by these salary sacrifice changes, and what they can still do in terms of drawing money from their pension hasn't changed.
And I think as well, as we always say on these, is if you're not sure, ask your advisor. Definitely. And that will help with both your time frame and how you can maximise any opportunity. Yeah. So moving over to you, Graeme, what do the changes in inheritance tax mean?
Well, thankfully, there are fairly few, especially compared to last year. We had huge changes to BPR and APR. But again, there's an awful lot talked about in the lead up to this budget about what might happen with inheritance tax. So there were lots of talks about taper relief changing and potentially exempt transfers, gifts, effectively, the 7-year clock that a lot of people know about being expanded. Those changes didn't come into force in the end. So that was very positive news. A lot of people were sort of expecting the worst on this side. Not much of that really happened. The only real change that came in was the £1 million allowance for BPR and APR, that's business property relief and agricultural property relief, that came in last year. There was this anomaly whereby husband and wife, if they had £1 million each, for example, if one died and left everything to the spouse, they would lose their £1 million allowance. So basically, if you gave everything to the kids direct, you get £2 million of allowances. If you gave it to each other, you only have one. So it's a strange quirk in the tax rules that meant lots of people had to rewrite the wills. But they've abolished that. So actually made it very simple and straightforward to transfer that between husband and wife. So the only inheritance tax change was a positive one. And actually the government listening to what we're all saying in the industry, that this is daft. We have very different rules for the nil rate band. Why can't it apply for the £1 million allowance as well? So positive that there weren't those great big sweeping changes that we were perhaps worried about or were expecting, but also an improvement to what they changed last year as well, just in time. That comes in from April next year as well.
Right.
Positive.
Yeah, thank you. And in terms of investors, Heather, how are the changes to the ISA allowance?
Yeah. So I think this was expected to come in. So the changes to the cash ISA allowance has been reduced for those that are under 65. So they were able to put up to 12,000 into cash ISAs if you're under 65. 65s and over still will get the full 20 if they want to put that into cash ISAs. But it will mean that under 65 still have a 20,000 allowance, but 12,000 is the cap in cash ISAs. And if they want to invest further into ISAs, it'll have to be into investment ISAs, which is more part of the government initiative in trying to get people to invest into UK businesses ideally, rather than keep lots and lots of savings in the bank. So it will impact some people. And I think alternatives really is to keep using your ISA allowance in full, because as we've seen, if there's rises in the savings tax and the dividend tax, trying to maximise what you can actually invest in tax-free is going to be more important, because again, that option is going to be quite limited now. So yeah, really explore investment ISAs and make sure that you're using that each year. The changes I don't believe come into until 2027, so we've got next year's limits as they are currently. But yeah, keep investing. And I think looking at alternatives, if you can afford to invest into things for more longer term periods, then looking at other types of investments that should generate more returns compared to the cash ISAs would be ideal.
And utilising that time between now and 2027 to really ensure that plan. Yeah. That's really good. Thank you.
There's also similar sort of investment in business in UK in general with the EIS and VCT commitment. There wasn't much actually the detail that I could see from the government at this stage, but there was a general statement in the Chancellor's speech that there would be further incentives for EMI and EIS and VCTs?
Yeah, so again, that's specialised. That's very much focused on UK businesses. So it's really to try and get as much investment into those small businesses based in the UK. I mean, they do carry a higher level of risk typically to other types of investments, but coupled with the extra tax incentives that the government are probably going to throw at them, it's definitely worth consideration. Very much get advice on that area though before you try and dabble in it.
Yeah, have those conversations while you've got time to do so. And as an extension of that, Graeme, what does the budget mean more directly for businesses? We talked a little bit there about the opportunities to invest, but if you're a business owner, what are those key takeouts?
Yeah, again, you'd probably be happier with this budget than you were last year. So the employers' NIC, certainly coupled with the national minimum wage and living wage increases last year were huge compounding effects on business. There's still the increase to national minimum wage and living wage this time around. So if you're an employer, you might well have those increases. They're not quite at the same level as they were last year. And there isn't that increase in the NIC to sort of double up on that problem from last year. But the only real thing that was talked about from the business perspective was the extra first-year allowance that was talked about. So freezing capital corporation tax rates, so that's good. They're still quite competitive rates across the G7. But also the extra first-year allowance, which basically allows you to invest in plant and machinery, equipment that you need in your business, and get more tax relief for it early on. So the more people invest in their own businesses, the easier it is to grow. And if they can save tax on that while they're doing it, it makes the whole business model a lot more viable. So generally positive news for business.
And then there was consideration around imposing a charge on limited liability partnerships. What did you see on that front?
Yeah, nothing. It was something that was talked about quite a bit beforehand. This is largely targeted at sort of London solicitors firms, but it's one of those things where you target a certain sector and it ends up impacting lots of people. The idea basically being if you're a partner in a partnership, you pay less national insurance than if you're an employee. That was the sort of rationale around it. There was a governance paper that was put out beforehand, which was sort of recommending this would be a equality measure to make things fairer, but it's really just targeting those businesses and sort of incurring an extra tax charge. It's a very difficult one to square that circle as far as I could see, 'cause different income sources do have different taxation treatments. That's just naturally the way it is. They had a similar argument with the rental and savings increase that they introduced, but they just naturally have that difference in taxation treatment. So it seemed a very different one to say it was fairer just to increase that on those people. And more importantly, they could do something about it. So those businesses could just incorporate anyway and get out of the whole problem. So it would have been great for tax advisors such as myself, because you get to give lots of advice on it, but wouldn't actually raise any revenue and achieve anything that they wanted to achieve anyway. So for now, it's been benched, but we'll see if that does come in the future.
And then I suppose a question for both of you, starting with you, Heather, is, you've now seen the budget. You're going to spend some time over the next few hours and days divesting what that means. What are your expectations over the next few days in terms of clients and your team? Yeah,
to be fair, I think most people are going to be quite relieved. It could have been a lot worse. There could have been a lot more changes in pensions that could have been quite detrimental to those that were looking at retiring. So actually, I think it's not too bad in terms of analysing it, because I think most people will be breathing a sigh of relief. In terms of where we'll probably be focusing on is the changes to the increases in the savings and the dividend tax, and making sure the current investment portfolios that clients have got are still the most tax efficient, or should we be looking at other types of investments to make things a bit more tax efficient for them.
I think it's a similar approach from a tax perspective as well. I think overall, yes, it seems like a relatively sedate budget compared to what it could have been. But I think that 2% increase for certain people with that investment profile, whether that's rental property or investment portfolios, that extra 2% will make a difference. So actually, how is that going to affect their future forecasting? How is it going to affect what their cash flow looks like? It's just ideal to work with your tax advisor and your financial advisor to make sure that your plan still works and you can still meet your needs.
That's brilliant. Thanks, Heather. Thanks, Graeme. It's been really useful for you to come and give us that initial reaction so quickly after hearing the news. Very much appreciated.
Thank you.
Thank you.